At some point after moving to France, usually when reviewing their first avis d'imposition, most British expats notice a line sitting beneath their income tax figure. It's not enormous, it's not nothing, and it has a name that sounds reassuringly administrative: prélèvements sociaux, social charges. Not a tax, you understand, merely a contribution to society, which France would like you to make every year on most of your income, whether you'd like to or not. If that sounds to you suspiciously like a tax with a more agreeable name, you are not alone. Welcome to French social charges. Let's work out what you actually owe. Welcome back to the Expat Accountant. I'm Ad, a UK qualified accountant and British expat living in France. Today we're tackling French social charges, the prélèvements sociaux, which catch almost every British expat by surprise and which interact with your healthcare coverage status in ways that can make a very significant financial difference. Quick disclaimer, as always, general information, not personal advice. Right, contribuons, which isn't a French word, but it should be. Let's start with what social charges actually are. In France, the social security system, healthcare, pensions, family benefits, unemployment insurance, is funded not only through employer and employee contributions on salaries, but also through a series of levies on investment income, rental income and capital gains. These levies are the prélèvements sociaux. The main components are the CSG, Contribution Sociale Généralisée, the CRDS, Contribution au Remboursement de la Dette Sociale, and a handful of smaller levies with equally impressive names. The French government has named each component with considerable imagination, presumably on the basis that if you're going to charge people money, you might as well make them feel they're participating in something rather grand. Together, they add up to a total rate that varies depending on the type of income and your personal situation. For most investment income, dividends, interest, capital gains, rental income, the standard rate of social charges is 17.2%. That is on top of the income tax, not instead of, on top of. So when France applies the 30% PFU flat tax on investment income that I mentioned in the ISA video, that 30% is made up of 12.8% income tax plus 17.2% social charges. The social charges element is the larger of the two, which tells you something about how France funds its social security system. For employment income and self-employment income, social charges work differently. They're built into the payroll and cotisation system rather than applied separately on your tax return. Today we're focusing on the investment and rental income charges that affect most British expats, the ones that appear on your avis d'imposition and that nobody warned you about. Right, here's the part of this video that could save you a significant amount of money. Pay attention. Since a landmark European Court of Justice ruling and subsequent French legislation, individuals who are covered by the social security system of another EU or EEA country and therefore not affiliated to the French social security system are exempt from the majority of French social charges on their investment and rental income. Instead of paying the full 17.2%, they pay a reduced rate of 7.5%. That's a reduction of nearly 10 percentage points on all your investment income and rental income every year. It is not a small difference. In fact, it's the kind of difference that makes a grown accountant slightly emotional. The mechanism for accessing this exemption is the S1 certificate, a document issued by the UK that confirms you are covered by the UK Social Security for healthcare purposes. S1 certificates are most commonly held by people who receive a UK state pension or UK government pension and have registered their S1 with the French healthcare system, CPAM, to access French healthcare on the basis of their UK coverage rather than through French social security contributions. Here's something many couples don't realise. If one partner holds a valid S1, their spouse or civil partner may be able to benefit from the same reduced social charges rate as a dependent on that S1. In other words, the S1 exemption can potentially cover both members of a household, not just the person named on the certificate. Given that French tax returns are filed jointly as a household, this can make the saving even more significant. It's worth checking your specific situation carefully. CPAM can advise on whether your spouse is registered as a dependent, because if they're not, and they should be, that's a correction worth making promptly. If you hold a valid S1 certificate registered with CPAM, you should be paying social charges at 7.5% rather than 17.2% on your investment and rental income. If you have been paying 17.2% and you hold an S1, you may have overpaid and a correction may be possible, which is absolutely a conversation worth having with a professional. Post-Brexit, this situation became more complex for British expats arriving in France after the 31st of December 2020. The S1 route remains available for those receiving UK state pensions or certain UK government pensions. For those not receiving such pensions, the position is less straightforward and has been subject to ongoing developments. If you're unsure of your position, and many people are, specific advice is essential. This is one of those areas where the difference between the right answer and the wrong answer is measured in thousands of euros per year. Let's run through how social charges apply to the main income types relevant to British expats. Investment income, dividends, interest, capital gains. Standard rate is 17.2% or 7.5% with an S1 exemption. Included within the 30% PFU flat tax on investment income. So if you're paying PFU, the social charges are already built in at 17.2. If you hold an S1, you need to elect for marginal rate taxation rather than PFU to benefit from the reduced rate. Your tax advisor can guide you through this calculation as it needs to work in your favour overall before electing. Rental income. Standard rate is 17.2 or 7.5% with a S1 exemption, applied on your net rental income after allowable deductions. This is where the S1 saving can be particularly material for expats with UK rental properties. The charge applies to the income declared in France, and 9.7 percentage points on a meaningful rental income adds up quickly over the years. French employment income. Social charges on employment income are handled through the French payroll system as part of the cotisation sociale, separate from the investment income charges we've been discussing. If you're employed in France, your employer handles this. The rates on employment income are considerably higher than 17.2% in total. French employment social contributions are famously generous in scope and famously less generous on the payslip. Self-employment income. If you're self-employed in France, whether as a micro-entrepreneur, in a liberal profession or through another structure, social charges on your trading income work differently again with their own rates, thresholds and payment mechanisms. It's a substantial topic in its own right and one I'll be covering in a dedicated video. If you're self-employed or considering becoming self-employed in France, that's one to watch out for. UK pension income. The social charges position on UK pension income depends on your specific situation, whether you hold an S1, your age and the type of pension. This is one of the genuinely complex areas of French taxation for British expats, and one where the numbers are material enough to warrant specific advice. Right, practically speaking, where do social charges appear and how do you know what you're paying? For investment income taxed under the PFU flat rate, The social charges are included within the 30% rate and calculated automatically by the French tax system when you file your return. You don't separately calculate them. They appear on your avis d'imposition as a line item beneath the income tax figure. For rental income, social charges are calculated on the net rental income and similarly appear on your avis d'imposition. For capital gains on property, French property specifically, social charges are calculated at the point of sale and paid through the notaire as part of the conveyancing process, alongside any capital gains tax due. For UK property gains declared on your French return, they appear on the avis d'imposition. The key thing to check on your avis d'imposition is that the rate at which social charges have been applied. If you hold an S1 and the rate showing is 17.2 rather than 7.5%, something has gone wrong and needs to be corrected. This does happen. The French system does not automatically know you hold an S1 unless it has been declared correctly. Checking your avis d'imposition carefully each year is not optional. It's how you catch these things. Think of it as the French tax equivalent of checking your bank statement. Dull, occasionally surprising, and considerably better done than not done. I want to zoom out for a moment and put social charges in context, because it's easy to focus on the rate and lose sight of the bigger picture. France has one of the most comprehensive social security systems in the world. Healthcare, which as a French resident you have access to, is genuinely excellent. Reimbursement rates for medical treatment are high. The network of doctors and specialists is extensive, and the system functions with the reliability that many British expats find rather refreshing after years of NHS waiting lists. I say this not to be political. The NHS is a remarkable institution, but simply to note that what France collects in social charges, it does broadly spend on social infrastructure that residents benefit from. For British expats who access French healthcare through an S1 rather than through French social security contributions, the reduced 7.5% rate reflects the fact that your healthcare is being funded by the UK rather than France. It's a coherent system once you understand the logic, even if the terminology, social charges rather than tax, remains a source of gentle amusement. The broader point is this: France is not a low-tax country, and it has never pretended to be. What it offers in return is a level of public services, healthcare and quality of life that most of its residents, including most British expats I know, consider a reasonable exchange. Understanding what you owe, claiming every exemption you're entitled to, and planning efficiently within the rules is the sensible approach. Indignation, while understandable, is rarely tax deductible. So, to summarise, French social charges, the prélèvements sociaux, are levied on investment income, rental income and capital gains at a standard rate of 17.2%. If you hold an S1 certificate confirming UK social security coverage, you should be paying a reduced rate of 7.5% instead. A saving that is material and worth verifying carefully. Social charges appear on your avis d'imposition and should be checked every year to ensure the correct rate has been applied. And the interaction between social charges, the PFU flat tax and marginal rate election is complex enough that getting specific advice, particularly if you have significant investment or rental income, is genuinely worthwhile. Next week, I'm covering something that surprises almost every British expat who hasn't thought about it: French inheritance law and how it affects what happens to your assets when you die. It's not the most cheerful of topics, I'll grant you, but it's one of the most important for anyone who owns property or has family in both countries. Subscribe so you don't miss it, leave your questions below, and I'll see you next Wednesday.